You held your SpaceX equity through the private years, delays, and volatility. Now the IPO is here, and you've hit the threshold of generational wealth. If you spend any time online, you already know the popular advice for what to do next: buy, borrow, die. The strategy says you never sell your shares. Instead, you use them as collateral to take out a loan and fund your lifestyle. This comparative bar chart shows exactly why the strategy is so popular. A traditional stock sale immediately triggers capital gains taxes, wiping out 20 to 30% of your value depending on your state. Borrowing against the asset leaves 100% of your wealth intact, and because a loan isn't a sale, you owe zero immediate tax. That math works perfectly if you are a billionaire with a widely diversified portfolio. But if you are a newly minted tech millionaire holding a highly concentrated position in a single, newly public company, applying this exact playbook is dangerous. Trying to treat a single tech stock like a diversified wealth fund introduces hidden liquidation risks. A sudden drop in share price can trigger a chain reaction that forces you to sell at the absolute worst possible time. We'll look closely at why your broker will likely reject your initial attempts to borrow, why standard margin accounts are a trap, and how you can actually structure debt safely after this IPO. Mastering the specific mechanics of post-IPO lending is the only way to ensure you don't trade a predictable tax bill for an unpredictable liquidation trap. Your first hurdle is entirely administrative. Right now, your shares are locked inside Morgan Stanley's ShareWorks stock plan environment, which limits your options. To access competitive lending, you need to move them to a personal brokerage account. That transfer happens through an automated system called ACATS. But the system is rigid. If the exact legal name and social security number on your ShareWorks account do not perfectly match the destination account, the transfer will fail and lock up your shares in administrative limbo. Even when the transfer succeeds, the lot-level cost basis data, the exact price you paid for each share, frequently drops out during the move. You will need your CPA to track this manually, or you risk paying double taxes when you eventually do sell. But the biggest myth surrounding IPO day is the assumption that once the stock is public and in your brokerage account, you can immediately hand it to a bank as collateral. This timeline maps the 180-day staggered lockup schedule in the SpaceX S1. It explicitly prohibits pledging restricted shares as loan security. You cannot borrow $1 against your equity until specific tranches are released. You must rely on existing cash until then. Until the 180-day lockup expires completely, your shares are legally untouchable for debt collateral. Immediate IPO liquidity is a complete myth. Let's fast forward to the moment your shares are finally unlocked. The fastest, most accessible way to borrow against them is through standard Regulation T margin. This scale breaks down Reg T margin. Federal rules allow borrowing up to 50%, enforcing a strict 25% maintenance minimum. But brokers write their own house rules. For volatile new stocks, massive haircuts reduce your actual borrowing power well below 50%. The appeal of margin is its total lack of friction. The credit is already embedded inside your trading app. There is no separate loan application, no underwriting process, and no credit check. The cash is just sitting there, waiting for you to click a button. But that frictionless access masks a fatal structural flaw for anyone holding a highly concentrated portfolio: the automatic margin call. Look at this line graph. If your SpaceX stock dips below the broker's maintenance threshold, an automatic margin call forces a sale to cover the deficit. The algorithm simply executes the sale instantly, guaranteeing your shares are liquidated at the absolute bottom of the drop. This creates a catastrophic double penalty. The forced liquidation permanently locks in your investment losses, and it simultaneously triggers the exact capital gains tax event you used the margin loan to avoid in the first place. For a concentrated SpaceX shareholder, a standard margin account is a live financial grenade, and the broker holds the pin. There is an alternative lending framework designed specifically for wealth preservation. It is called a securities-based line of credit, or SBLOC, usually offered by private banks. This split screen compares the structures. Unlike margin, an SBLOC moves your collateral into a completely separate pledged account, isolating your shares from daily trading. The trade-off: proceeds are designated non-purpose. Legally, you cannot use this cash to buy more stock or pay existing margin debt. Despite that restriction, the structure is vastly superior. Private banks use risk-based pricing and call mechanics that give you days, not seconds, to cure a deficit. It is insulated from minute-by-minute trading algorithms. However, we need to correct a dangerous internet myth regarding the loan-to-value limits you can expect. This chart compares myth against reality. While diversified portfolios might command an 80% LTV, lenders apply a heavy haircut to a newly public single stock, capping borrowing power at 50%. This conservative haircut is a crucial feature, forcing a wider safety buffer. An SBLOC takes longer to establish and restricts how you use the cash. But the structural separation and stable call mechanics make it the only mathematically sound choice for concentrated post-IPO wealth. Debt-backed liquidity remains an incredibly powerful tool to defer taxes, but it only works if you respect the unique dangers of holding a concentrated position. This scorecard outlines the exact playbook required to navigate the coming month safely. Step 1. Export your cost basis. Step 2. Wait out the lockup. Step 3. Execute your ACATS transfer. And Step 4. Negotiate your S-block. If you are an eager optimizer who absolutely must use standard margin for a short-term bridge loan, your borrowing amounts must be kept aggressively low. That is the only way to survive the daily volatility. For everyone else, the cautious and correct path is patience. Wait for the 180-day lockup to end, execute a clean in-kind transfer, and establish a structurally secure S-block with a private bank. Regardless of which path you choose, follow the golden rule of post-IPO borrowing. Keep your total cash draws strictly under 25% of the collateral's value. That is how you build an unbreakable safety buffer against a sudden drawdown. The biggest threat to your newly acquired wealth is not the IRS tax rate. The biggest threat is a forced margin call on a volatile, concentrated stock. Leverage should be used as a deliberate bridge to slowly diversify your portfolio over time. It is never a permanent substitute for true asset diversification. By rejecting the internet hype and mastering these precise loan mechanics, you can safely survive the IPO transition, defer your taxes, and truly protect your equity.